All right, today I am joined by Matthew Kidman. He's the principal investor at Centennial Asset Management. He's been investing in the Aussie stock market for a very long time, previously with Jeff Wilson, and he's also the author of this book, which I'm proud to own, Bulls and Bears and a Croupier, which is going back 10 years. Today we're going to talk a little bit about why Matthew turned bullish last year, where he sees the market at, and hopefully a few stock ideas for you. So Matthew, thank you for joining me.
Thanks for having me.
I want to just go back to last year. I know you were one of the fund managers that were happy to go out in public and say you were looking for the market to turn bullish. And I was curious whether was that experience that led you to that conclusion last year, or was it from data points that you saw, or some combination of both?
Yeah, so what I've learned over time is that when you're in bear markets, which we were, because we concentrate on small companies in Australia, and 2022, once interest rates were rising, we got into that bear market, and small caps in particular were sold off quite aggressively. The Australian market looked for safety. It bought its big companies. It wasn't an outright bear market, but it was tough at the small end. And it was very tough in the US from a technology point of view, as you remember, where all those companies got hit hard in terms of you can't just discount losses forever and then promise a profit down the track. So they had to bring all that forward. They cut costs. And what made me think, when you're in a bear market, the actual analysts who look at fundamentals tend to get it wrong. Even though fundamentals are always important, they get very bearish, they get very gloomy. But what we saw in the US was, I think, late September, early October 2022, the tech market started to turn around, which is looking at the NASDAQ in particular. And a number of its leaders started to turn around. And you put in a couple of months of seeing them rise, and they kind of broke that downward trend. So the technicals are pretty important when you're looking at why market turns, because everyone gets so negative, but the technicals don't necessarily get negative. And we thought that was a lead indicator. And so we followed that. And in the meantime, inflation was coming off its peak, which was another indicator. And markets were starting to heal. Took a lot longer for the small caps in Australia, and that's why I said last year, as opposed to the year before, that's when the bear market was probably over and we were going to turn. So that was the fundamental basis. Things look cheaper, obviously, and you always got to look forward rather than just get bogged down on what it looks like today. And the technicals were telling us that at the time. That's how I read it anyway.
It's funny. Last year I did this speech in November, and I was urging the guys to sort of scoop things up when they were cheap. But it had been such a grind for so long that you felt like you were saying the same thing over and over again. Have you been surprised by how quickly? And then in hindsight, we look back 4 months later, and the market's ripped up really fast. I certainly didn't think it was going to go that hard and that fast. Have you been surprised by what's happened since late last year?
Yes and no. It's probably a little bit more aggressive than I thought, but normally bottoms in markets, if you can pick them, which very few people can, and I'm not suggesting I can. I was just saying in general, I thought we might have hit a bottom. They tend to, the first 4, 5, 6 months is the best of it in terms of just outright straight up, because there's so much negativity, and then people have to cover if they're short, and then people have to get long because they've been defensive, and it just takes that 6-month period. Post that, which I think we've entered now, is you got to go back to those fundamentals that we're talking about. And so we're probably at that stage, which we're at a very interesting juncture after that bounce, because the negativity has largely been removed in this rally.
Interesting you say that. There's this book that I love that just look at my thing. I don't have it to hand, but it was called Building Wealth in the Stock Market, from a guy called Colin Nicholson, who I think he's retired now. Hopefully, if he's still alive. But he called the first phase of a bull market increasing confidence, which I sort of adopted in some of my presentations and that type of thing. Then he sort of suggested stage 2 would be the longest one, but it was increasing earnings. So you have to find those companies that are growing their revenues and sales and all that type of thing. And he said that can run for quite a long time. Is that sort of roughly the transition that you're looking for?
I think that's where we're entering. And there's a little bit, even though the very negative vibe that we had, say, last September, October, especially in small caps, has basically gone away. there is some doubts re-emerging, which is good for a bull market, I think, as long as they play out okay. So we've got oil on the rise, which is never good for the general equity market. It's good for resource, good for energy, as we know, but beyond that, it's tough for the general market, slows economic growth. And of course, that feeds into inflation. And the US economy in particular has been a bit stronger than what everyone thought. And inflation has got a bit sticky in that 3% range. So the markets have started to get a few, after going very negative to very bullish. Now it's kind of rebasing and saying, well, we can see some issues out there. And I think your analysis and your reading is right. The middle of a bull market, you get the initial kick up stage, which is very sharp. And then the middle is about earnings. And the last bit is about optimism and PE expansion beyond belief. But now I think we're entering that earnings phase, which tends to be the longest phase. I should put it in perspective, though. I think this is the last leg of a bull market that started in 2009. And it will play out like any bull market and last a period. But really, when you look back, even the COVID crisis, the downturn we had in 22 didn't really take us out of that trend line that we're in at the moment that started, way back after the GFC. And it's getting quite long. You're referring,
sorry, I've jumped in, like a generational bull market, that kind of 20-year thing. So do you think maybe there's 2 to 3 years left of that, or you're not?
I would suspect so, but I'd hate to put an exact timing on it. We all know, the people who've followed a long time, Alan Greenspan, the then chair of the Federal Reserve, came out in 1996 and said there was irrational exuberance in the US market, and the next 4 years were unbelievably strong. And so, you can go 100% in those 4 years. So it can last longer. But I do think that this is the generational bull market. The previous one was, and I'm going on US markets here, which lead the world, obviously, was 82 to about 2000, top of the tech wreck. That was 18 years. Prior to that, it was coming out of the Second World War and the ramifications from the late 40s into the late 60s. And so they're all somewhere between 15 and 20 years. And now we're at the 15-year mark. And it doesn't feel like it's over by any way. We haven't got to that irrational exuberance. So I think it can go for a fair bit longer. But I think we're in that last phase of that.
Just on that, I was flicking through your book again. I really like this book, by the way. Because one thing Aussie fund managers don't do is there's a lot of literature out there from US guys, but not so many Aussie fund managers do this kind of thing. But at the time, you were writing that the GFC had happened and that the Aussie market had risen, but people had been so burned and that they weren't kind of participating. Do you feel like, I feel like we're in a similar dynamic where the retail component is not really in the market, and that's sort of another bullish thing because they're yet to come in, if you like.
Yeah, I think the retail component of the market in Australia really got burnt hard. Third-degree burns out of the GFC. It took them years and years to come back in. And strangely, when they did come back in, they were probably the next generation of retail investors who had that appetite for risk. And it kind of emerged not so much in the stock market, but in different funny little sectors. Of course, crypto's the headline act in that, where it became this incredibly liquid, volatile market that younger people in particular love to play. There was also different booms through that period. So we had the marijuana or pot boom that emanated out of Canada into the US with the deregulation, and we saw a bit of it. And you get these different variations on it. But broadly, in the equity market that we would have experienced, leading up to 2007, we had 4 or 5 years, the retail market didn't really appear, only in bits and pieces, I've said, in niche markets. So I still think they're on, and 2022 saw them duck for cover again. So they've got time to come back in. And unfortunately, they're the ones who'll play that back end market, as we always know, where the last 18 months, 2 years, where things go a little bit crazy.
So with Centennial, I just happened to listen to a podcast from another fund manager, and he said a lot of small cap fund managers don't invest in resources. They're generally focused on industrials. Are you willing to go anywhere in the market?
We are, but we'll never be overweight resources. It's just not our cup of tea. I was a child of the 1990s, when I learned to invest. And that's probably been a bad thing, because you were taught back then that returns on resources were poor through a cycle. And then, of course, we walked into the China story in the first decade of 2000s. And that that was just then that was the only place to be. So I had to learn how to get into resources and understand the fundamentals of what you're looking for, but was never consider myself a specialist in any way, shape, or form in that. But there was enough there to learn, and then obviously that unwound in 2012 to 15. And so, there's a rebalancing, but we're more industrialists rather than resources.
And we've just been through earnings seasons. Is there particular thematics that you're following if you're not heavy on the resource? Because Australia is such a resource-driven market in many ways. How do you guys look to take advantage of the current market?
Yeah, so we're lucky in the sense that we're a small cap investor, but we can virtually go anywhere in the Australian market. So through 2022 into 23, we, like a lot of other people, went into the big end of the market or rebalanced our portfolio. It kind of became half our portfolio. They're better, stronger franchises. They don't grow as much, but they're more stable. And that's what it means about being defensive, that they grow at a slower rate, but just more consistently. We've wound back into the small caps. Now we're back to what we would say is pretty normal, our balance, where we're about 80% small caps. And there's quite a few interesting themes that have come along. The big one was how they're handling the inflation situation. And as we know, 2022 into 23, costs were virtually insurmountable in terms of being able to retain your margin for a lot of people after an incredible period during COVID. So as we move forward into this reporting season, it seems like the bulk of companies have been able to get back and restore their margin. Not all of them, not completely, but the majority of them have found it, and there's been different pockets. So a little bit of inflation has come off around shipping, a little bit of inflation around raw materials that spiked. Obviously, that the Chinese, if you're an importer, the manufacturing costs have come down because they're pretty desperate for volume, and Australia has been able to fill some of that void. So cost containment has been a good one. And obviously, you wheel through the different sectors and say, well, what hasn't recovered yet? Some things have recovered early, other sectors haven't. Interest rates are playing a big role in that. Who benefits from stable interest rates as opposed to ones that are going up? So yeah, we look at the macro, and then we look down into the individual companies, and we meet hundreds of companies to see how they're going.
I just laughed there for a moment because you mentioned the marijuana boom a few years ago. I remember that. And if there's one sector that has never recovered, it is that sector. Do you guys spend any time?
It's actually had a couple of good months in North America. So don't be surprised if it resurfaces. I don't think in the same catastrophic way it did in the whenever it was pre-COVID. It just took off, and there was just ridiculous numbers. People were just buying it. It just felt good, like smoking the stuff. It just felt good.
You mentioned that you were 80% small caps. For people that aren't familiar with fund management, that type of thing, how many positions would you spread across your fund as a general rule? Do you have a certain thing that you have to have?
What we tell our investors, and we try and stick to this as best as we can, about 40 core positions. So that allows you to be between 1% and 5%, depending on the liquidity of each stock. There will be stocks going in and out of the portfolio because small caps re-rate at a very speedy fashion, and that means that you hit your price points fairly quickly, either up or down. We're at that point now where, because the optimism is growing, it's easy to get a downgrade in earnings and a re-rating down at a rapid rate. We've had a couple of those through the period, that even when the market's rallying, but it tells you that expectations are built back in and earnings have got to go with it. So we mix it up in that sense. So we'll have about another 10 stocks going in and some coming out. So if you looked at our portfolio, you might see 50 stocks staring at you, but there's 40 core ones that we're investing in.
And the highest value will be 5% of the fund, that you won't go overweight higher than that?
Yeah, we will, but that's 5% on the way in. So that if we get a good stock that goes, up 40, 50%, then, and we put 5% in it might grow to 7 or 8, but we won't go any higher than that. We'll start obviously letting some go, not only because of valuations, but just portfolio structures that we don't want to be too, because none of our stocks that we've got are too big to fail. And it is a volatile. We spend most of our time trying to manage our risk to get a return. We just, if you ask me what I did as a living, I'd say I manage risk as opposed
Well,
to stock
interesting you say
picking.
that, because why are you doing this as a living? Because in this book, you retire.
Yeah,
What brought
yeah,
you back?
correct. A couple of things that when I went away, I had a bit of a break. I looked at, and I did do a number of things. I went on a few boards. I went out and did a PhD, and for 4 or 5 years, I managed my own money as such, and that was quite good. I had a young family still, so it was a great test of whether I could manage my own money and make a living. It's a different kind of challenge and
Was that a
stress.
trading thing, or you were just managing capital, kind of like a long-term investor, or were you actively trying to day trade or what have you?
No, no, no. It was more like investing, like I had done at WAM at Wilson's, and what I do now. I haven't really changed. It's just the size of what you're doing. But in 2015, I sat with another gentleman, and we managed our money, and we managed for one client all through that period, who liked us, and but we managed it our own way, managed risk, and then we decided on for several reasons. One of them, it's hard to stay relevant if you've got $300 million to invest. People will treat you, whether it be companies or brokers or corporate departments, will treat you like an institution. If you've got a percentage of that, a much smaller percentage, then you start to drift and you lose your contacts with the market, because you ring a company up and say, "Can I come and see you? I'm interested." Or become a shareholder. They'll look at the thing and say, "Well, who are you?" So we went back in, Gary Joffe and I, and said, "Well, let's raise a certain amount of money, but still manage it the way we would, rather than," and that means that we manage risk. So when we don't like markets, we'll go to cash. We've got the ability to short. We do it sparingly, and you do it at the big end of the market, so it's a slightly different. But we've got a lot of bells and whistles which we can move around, which helps us a lot. So, that's how we got back in. And to give you an idea how we're a little bit different to everyone, during COVID, when we had that 5-week sell-off, the small cap market in Australia from top to bottom fell 42%. We were down about 14. We were long, but we increased our cash position, and then the key was to get back on the bike and see if we can invest over the coming months. And that was probably the hardest period, reinvesting, because, as I said, optimism had disappeared. Everyone was pessimistic, and we hadn't seen anything like that. So we've got those abilities to move stuff around. That's how I would manage my own money, and that's what people get when they invest with us.
So a lot of the guys that will see this will either run their self-managed super fund or have an active portfolio. What advantage are there to doing your own thing as opposed to being a fund, do you think, having done both in a way?
Yeah, so doing your own thing is, you don't have, well, the obvious one is you don't have to explain yourself to anyone. So if someone say, "Well, why were you in this stock that went wrong?" which we've all done before, you only got to deal with it in your own four walls of your head type of thing. If someone else, so you're not answering to anyone. And obviously you'll be smaller, or most people will be smaller, and you can be a little bit more nimble. And you can do things like, if you want to go on holiday, you can cut out most of your positions and lower your risk and go on holiday and come back. Those kind of things you can't do that if you're in a fund. You're managing stuff every day. You're answering to people. But the downside is what I said. You can lose contact because you're smaller, and your relevance is not as high. So you get out of your network a little bit. So there's pros and cons, and I've done both, and they're both very enjoyable.
Do you do a lot of company meets then, going to see the companies? And what do you do when you get there? What are you looking for?
Yeah, so we do a lot of company contact. If you go back 25 years, that was a bit unusual. There was only a handful of people in the market that would see companies all the time. And I worked with Jeff Wilson, and he said that's where you get to know the companies best and the people, and we should do it. So we do a lot of that. And so when we go and see a company, what you're after is to get a feel for what how they manage their company and where they're taking it. So sometimes you'll get results like we've just been through, and you look at all the different things: revenue growth, margins, cash flows, all those things, and you'll talk about that. And but what you're really trying to learn from them is what's the prospective future for this company, and how will you go about prosecuting that opportunity. And you want to see what the culture's like, how they present themselves. You want to keep asking them the same questions to see if they keep doing the same. They're consistent in what they do. So you see companies sometimes 2, 3, 4 times. You want to learn a lot more about the workings of the company and where it's going.
Interestingly enough, I have a hobby of following the non-banks, which not many people do here in Australia. But I know that you mentioned them. So I think I saw you on Livewire talking about them. Were those some of the companies you were kicking? Because they were absolutely hammered and down in the dumps, and still kind of are, really. Have you kicked over the rocks with those guys?
Definitely. So that's one sector where I said some haven't picked up from this bounce, and in general they haven't. And there's quite a few companies in that area. Going from quite large ones like Liberty and Pepper, large in terms of small caps and quite big. There's Resimac, there's AFG, which is the broker. There's quite a few. And what happened is, I think that is a classic situation where financial stocks that lend money to people, whether it be individuals for their mortgage on their home, or individuals for their car, or SMEs for the investments in their businesses. They were all small cap stocks, and they were growing quite quickly, and their distribution to market was mainly online. It was a different model to the old branch model. And so everyone valued them on, like all small cap investors, how fast do you grow and what kind of multiple we're going to put you on. The big guys who look at banks, they don't really do it that way. Sure, they look at how much earnings growth, but they always bet it around, well, how are you valued compared to your book? Your assets minus your liabilities. And what we've seen in this non-bank small cap sector in this bear market they've been through is rising interest rates. It seems to me that they've thrown out the earnings growth back down to, how you value compared to your book. And guess what? Most of them will come back to book or a bit below, which is interesting. So there's definitely opportunity there, because I think as time goes on and people get a bit more confident and interest rates stabilise, well, hopefully they do, then you'll start to get that multiple coming back into earnings growth, and books will be able to grow as well. So there's an opportunity
And
there.
they're quite profitable businesses too when they get going, right?
Yeah, it takes a lot to get it out of the ground, but yeah, they can be quite profitable, especially if debts stay solid, as opposed to bad debts rising.
Another one I was going to mention to you was Cedar Woods Properties, which you happen to mention in this book. And the reason so is because you've been around so long. Obviously, some of these cyclical names go for a big run, and then they get dumped, kind of thing. Is that a stock that you're actively following?
Yeah, we actually own it again now. So Cedar Woods is a property development group based out of Perth, and they buy lots of land and the development from the ground up. They get the land approved, they build the infrastructure. Sometimes they sell it at that level, but most of the time they'll build apartments on it and then sell it off one by one. So it's from start to finish. About half their business is in Perth. There's quite a big chunk in Melbourne, and then there's Brisbane and Adelaide. They're not in Sydney. So that's quite good, because what you found is Perth runs its own cycle typically, and Perth at the moment, real estate prices are going up quite strongly over the last 2 years, as opposed to the East Coast, where it's been the opposite. So it's leading the charge, and that's good for them. They actually got to a point where they had too much debt on the balance sheet. They had to sell some assets, but now a lot of their developments are starting to settle because they're fully done, and so their debt will come right down. And so even if their enterprise value, which is a combination of debt and equity, stays steady, what will happen is the debt will come down, and so the equity will be worth more. And it trades at book or a bit below, because all the assets on the balance sheet are understated. We think they're pretty good managers. I think, wouldn't surprise me if the WA housing market continues and the East Coast picks up a little bit over the next 2 years, that it could easily go from $4.70 to $6, something like that, which is closer to what NTA would be.
I've noticed over the years when it does go, it does really go. Do you feel it tees off, because it's one of those stocks that's still just bottoming out and going sideways a bit? Is it the market chasing when it clearly sees the property market moving? Do you think, or is when CWP goes for those runs, is it earnings driven? Is it pre-sales driven? What do you feel like kicks it into gear, if you like?
Yeah, so we're looking at what's the catalyst for that?
What's the catalyst? Yeah.
Because everyone's got the same information in terms of the numbers that they produce, and you can access them online and any presentation. So you've got to look for that catalyst that will change the market's view of the stock. Valuation helps, because then it's got the ability to go up, but then you need that catalyst. I think it could be a couple of things. I think this is the kind of stock that's been forgotten a bit. So you've got time to build a position. And I think when we get to the June 30 results, which we'll see in August, that the balance sheet has repaired itself quite a bit, and they'll come out and say that most of our markets are going quite well, especially WA and Queensland. and that, the next couple of years we're quite optimistic about the outlook. So earnings will grow as those developments come in, because they can have the long digestion period, and if things aren't selling quickly like they have it in the last 3 years, then their balance sheet takes on a fair bit of debt to keep those assets on. But then they start to realise them, and I think that's the catalyst. We're turning that period where the debt will come down and the outlook will be better. So there's a bit of time to build a position.
You mentioned you have a co-investor there at the fund. Do you guys ever have a situation where you may slightly disagree on an idea or how big to go on it, and how do you work through those clashes?
You mean the portfolio managers? Yeah.
Yeah.
No, we all sit in the same room. We discuss things. There's normally a champion for a stock because they've looked at it. We might get the other person to look at it as well and get a bit of agreement on it. But normally you back the person in the room because, you go through the fundamental analysis. What's it worth? What's the balance sheet look like? What are the management like? Let's meet them. All those kind of things. You get a bit of agreement, but you normally, the person who champions the idea, who's found it, will normally back them. And then it comes around to what size position do you want? What's the opportunity? What's the liquidity? And so, we normally get agreement. Occasionally you say, well, I'll let you do that one because either I don't know a lot about it or I'm finding it hard to understand. You occasionally do that, but most of the time we get agreement.
And when it comes to your little book here, I mean, do you think back? I mean, is there going to be a second edition? And is there anything in here that you would add with 15 years, roughly more experience? I mean, what would you add to the book what you didn't all those years ago?
Yeah, so that book came out of, I was leaving Wilson Asset Management, and Wilson Asset Management was different. It had a lot of listed investment companies and a lot of retail investors, and they were great. We did a lot of presentations, and that book was a little bit of an effort to answer a lot of the questions we got over 13, 14 years from all our presentations. People would put their hand up and say, what about this stock? Just like your Cedar Woods story, or what happens when there's a downgrade, or what happens when there's a management problem. And I tried to answer as many of those questions in real life examples. And then I tacked on the end, well, where are we in the market? That was the last kind of 20% of the book. But the first 80% was just trying to answer those questions. So is there another book? No plans for a book, because those books are, you don't make money. They're big efforts. They're something that you do suit your own ego to a degree, and you need a motivation like that. And we'd written a couple of other books prior to that about investors and so on, which was a lot of fun. But this was the first one where I had to write it by myself, and it was all in my own head. They weren't interview based, which was quite interesting. What would I add if I did do a new book? Sure. Well, we've had a lot of history since then. We've had the COVID crisis, and we've had European debt crisis, which when I was writing that was unfolding. That was way back then, and we've had interest rates up and down and so on. But I think the world has changed a lot in that period, and investing's gone with it. And there is a new generation of investing. Sure, we talked about cycles. Stocks like Cedar Woods have been around for a long time. Traditional business, property development, it's been around for a long time. But there's a lot of new businesses that have emerged, mainly in the technology area, not exclusively, but mainly, or they're technology enhanced. And we talked about the non-bank guys. You could never have done that before because no one could build branches. It was online, getting to customers, different way of doing it. But I think and that's all positive because new, creative destruction, it's always good. You just got to move with it. But probably on the negative side, I think what's happened is the smartest guys in the room have been the tech guys in the US, and they've retrained everyone on how to look at investments. And some of that's worked and some of it hasn't. But they concentrate, like when a PE now is something that's almost forgotten. It's an EBITDA multiple. EBITDA multiples or EBITDA earnings are a lot easier to manipulate. And then we've fallen down the path where there's, ARRs and TAMs and all that kind of stuff, which we thought had been washed out in 2022, but they're back already and they haven't been washed out at all. And so they've been retrained, a lot of the investors, and it's been hard to follow because you've got to change in what you're looking at. And anyone who's a little bit cynical, because what I do is primarily, what's my foundation of investing? The first thing I'll look at is the balance sheet and the cash flow. Then I'll look at the earnings growth. And so that's really how I would go about it. Cash flows now have been, not only the regulators changed how you produce your cash flows, print them out in Australia, but people have looked at it a bit differently. Well, all of a sudden we've got operating cash flows. People ignore money being siphoned off. And software companies have got the best of everything there because they know that they can capitalize costs because they're developing all the time and they've got a lot more flexibility than anyone. So that's the negative bit I find really hard. And so all they want you to do is concentrate on the top line and the EBITDA and the prospects. They got called out in 2022, but they're back now and technology, there's some great technology companies. I'm not saying it's all bad. They've led the market. If we're all smart, 35 years ago, we would have put all our money into the NASDAQ and just gone on holidays. But yeah, and that's what we should have done instead of trying to turn up at work every day trying to pick stocks. It's almost been a fruitless task compared to that, but obviously very few people did that. But there has been a big change, and it's a generational change. And I don't know whether that's a good thing, but that's where the world is. So you kind of got to adjust to it.
Well, we can't go through 2024 without mentioning artificial intelligence. So
yeah,
do you think it has a role to play in your stock picking at all? Or is it, obviously it's very American based at the moment, but do you feel it's infiltrating Australia?
Yeah, I think so. I mean, it's very limited in what you can expose here. And eventually it will just bleed into everything, you would think. In every company's going to have to use it to help their business in some form or another, either lower costs or just sharpen their marketing. And a lot of companies have been using it for a long time anyway, especially the tech companies. Where have we got exposure to it? One of the few big caps we're stuck with is Goodman Group. So, they've been traditionally industrial property, both construction and management of it. It's been a fabulous, story in Australia, one of the great growth stocks. Well, now they're building data centers now. It's growing part of it. It's not a big part, but it's growing. And that's good. We can get it in other areas in the construction phase. Obviously, there's NextDC, there's Macquarie Telecom, which we've had for a while. There's even a couple of electrical companies that are winning because data centers use a lot of power, and we need more and more data centers because AI is so data driven and power driven. So, things like SKS Technologies we've owned now for a few months, one of the newer stocks.
I haven't heard of that one. Can you tell us about that one? SKS Technology.
Yeah, it used to be called Stokes, and it's a little electrical company based out of Melbourne. Never made any money, or not any meaningful amount. I shouldn't be so dismissive, but it was never. It was make a little bit, lose a little bit, and just existed. And you'd wonder why it was listed. Family-based company, and now its growth engine is the fact that it's starting to wire up data centers around the country, and that's there's an AI flavour to it. But we'll get more of it. There's just a few examples where we can do it now in the construction phase. We haven't got the chip market here, as you know, and we haven't got the technology market, but we have got, different bits and pieces that will benefit from it. But I would say in 5 years' time, all going well, most companies would have started to extract the benefits that come with AI. At the moment, I think there's a lot of hit and miss. So I was talking to someone who's not listed in Australia, but run a division of a big American tech company that lives in Australia. And I said, how is AI? And he goes, we've been using AI for a long time, but it's got better and with more resources behind it. I said, how's it going? How's it benefiting the business? And the answer was, well, actually, most of the time it doesn't, because there's a fault in most AI. If you ask it a question, it will always give you an answer, right, wrong, or otherwise. And so if you go down the wrong path, it compounds the problem, because it's just data driven. And so then you've got to stop it and restart. You've wasted a bit of time. He said that's probably happening more than the benefits at the moment. But eventually we'll get it right. We'll be better at it. And so it will be very important to our business. So there's a lot of that going on at the moment.
When you talk to investors, your own investors, that type of thing, did you have to sort of calm them down last year and get them to focus through the difficult period, to get them to focus on the long term? Or do you find that they're calling you up more when things get volatile and difficult, and that you kind of have to address those concerns more often?
I think if you look at the last two sell-offs, so there was 2020 and that wretched period when everything shut down around COVID, there was a lot of energy in the air, and there was a lot of calls and a lot of individual calls about what we do here. And rightly so, we hadn't seen a shutdown of the economy and then a reboot like that. With the 2022 sell-off on the back of inflation and rates going up globally, it went quiet. I wouldn't say that, we tried to talk to people, but they kind of just went into their cocoon a bit and found it all a little bit. Yeah, so there's different reactions from investors. And what they'll do is normally an investor will put up with downside, which is interesting because they understand that the world's changed. but they'd like you to capture the upside when markets run. So they've got, most not all, but a lot of individual investors have kind of got that. They haven't got that long-term like real estate that you own it forever, and it will be worth more over time. With small cap shares, they say there's moments I want to be in there because it's running. They don't investigate why, it just is. So they miss the first 15% and then they start to get interested. And you've got to manage that for them, because you know that that everyone gets too bullish eventually, and you've got to manage the eventual downside that's coming, but try and get the upside. So that's what I meant about risk. There's a lot of risk attached to it, and unfortunately, most investors don't manage that risk too well, and we've got to try and do that. It doesn't always work, but that's what we try and do.
Well, Matthew, it's brilliant. I feel like just to tie up, you mentioned, I'm curious with this idea where you've got this generational concept of like the 20-year bull market. I mean,
Yep.
when we get to that peak, and there's always going to be some peak down the line, is
Yep.
that when you decide to wind up the fund, or will you do like a Warren Buffett and go to your grey haired and can't get out of the car anymore? I mean, are you thinking like, how do you view your future role as an investor type of thing?
Yeah, that's a great question, and I think you nailed it before, that we're now in that middle phase where it's the economies and the companies are going to grow their earnings, and that's a nice spot because you can pick stocks and talk to them and see that their industries and their businesses are going well. So I don't think it's in the short term. That's my feeling. Now, the caveat to that is that inflation doesn't go away and it heats up again and they've got to put rates up again. I think that could knock markets around. But let's assume that it stays about where it is. I'm not a big advocate for lower rates in the short term, and haven't been all along. I was just happy if they stabilise because the economies are okay. So I'm thinking it's a few years out, and you'll kind of know that things will start to, well, they should in any bull market, things start to get a little bit crazy. We see bits and pieces of it, we said before, and we haven't. The market hasn't attracted like crypto has, so it might take a bit longer this time, and it could be a bit shorter, that sharp bit at the end. Will we be ready for the eventual sell-off? No, because we won't know the day. Will we be keen to to unload and reposition our portfolio at some stage? And then yes, we've got to work really hard and stay close to it. What will we do? Well, as I said, we've got a lot of bells and whistles, so we can play defence reasonably well. And is it another GFC? I don't know. It depends how long the bull market is. It could well be. We could be here in 4 years' time, and where the markets are double, and you go, holy moly, how good's this? Nothing can go wrong. And there's a GFC. Yeah, but that's the attitude that happens. I mean, you've been there.
Yes.
We've all been there.
Never get blasé.
All the problems just disappear. But we'll go to cash. We can short. We can get defensive with bigger caps. We can play defence better than most, but we won't get the day or even the week. But we'll stay really close to that exuberance that Greenspan talked about way back in the 90s. You can see it. You can see in the capital raisings that should happen over time. You can see in the types of businesses that are coming along, in the stronger for longer, kind of all these things start to come out and you've just got to be aware of that, and you've got to play it while it's there, and you'll end up with a bit of egg in your face, but you've got to be ready to move when you realise. You just don't hang on. You don't get scared. The toughest times are when markets turn, and it's obvious that, I remember January 2008. Everyone was on holidays, and I talk about it in that book. That's how one of the opening chapters, if I remember correctly, came back, and the first 12 trading days of January were down. And it was obvious the bull market was finished. And in the first 2 or 3 days, you don't know that. Even the first 5 or 6, and you come back the next week and they're down again. I'm talking about 1% a day, like we're down 12 or 13% in that 2-week period. And you go, okay, there's going to be a bit of a bounce, but it's gone. The market's gone. Capital is not going to be available for these companies in the future. And a lot of companies start to build models based on future capital being available. That's also dangerous. And it just dried up. And so they're hard periods because most people just want to go and sit in a bunker somewhere and go, don't tell me. They can't face it. You've got to sit there. You've got to be very clinical about it. You've got to unload stocks that don't make sense. You've got to get liquidity back in your portfolio, and you've got to bunker down. Now, you won't, when COVID happened, we didn't stem all the losses. But we acted quite quickly, and that was a real slap in the face because everything just closed down. We all lived through it. Never been through that before. It's going to happen again. It always happens. It just repeats time and time again. But I look at it, and you can look at a chart. Now, I'm not a technical person, but I do like to look at charts because they tell me stories. Bottom in 2009 was the bottom of the trench, and we've been going up and down, and a few times we've hit the bottom of that trench, like in COVID. Maybe even went below it, but we were back above it very quickly. And we're going to pop out the top of that in the next 2, 3, 4 years, and what we're just talking about. And that's when you've got to get really, really cynical about what's happening.
I got a wealthy mate, and I was whacking him over the head with a newspaper last year saying, allocate some money to a small cap fund manager, because it's just like, it just made so much sense to me. But it's not too late. So for people that are watching this or interested, how do they find, if they are interested in investing in, like, through the fund, small caps, how do they find what you do?
Yeah, look us up on our website. Give us a call. It's centennialfunds.com.au. Look us up. Give us a call. There's a gentleman called Michael Carmody who just sits on the phone all day waiting for your call. He loves talking to investors.
He does like a chat.
Yeah. Yes, exactly. You've met him. He loves a chat. We do a monthly newsletter. We do quarterly video presentations that you can look up. They're all on there. But contact him, Michael Carmody. Go to the website, find the number, give him a call or send him an email. And, we don't have we've got this philosophy because our money's in there. Our model is that we keep our funds quite small. So I talked about that 150. That was, 9 years ago. We think we can manage close to 300 mil and probably get the returns that we want, which is 15% gross. We've done that so far in our history. And today we sit at 220 mil. We'll raise that money or grow the funds to that point, and then we'll just cut it off to people because we'll grow it organically because we actually want the returns. And what I didn't say to you before, but when we started the fund, we put all our money in the fund with everyone else. We don't have money, punting on stocks PA or anything. It's all in the fund. And so the insiders have got about 20% of our fund. So, that's why we manage it like it's our own money, because it effectively is, along with others. Some people don't like that. We'll go to cash sometimes, like I said. We'll short the odd stock in the bigger end of the market. We'll get defensive. We'll play liquid stocks. But we're just trying to eke out a consistent return. That 15% gross is what we're trying to do. And
well, it's true. The bigger you get, the more cumbersome it is, isn't it, to get in and out of positions and that type of thing. It's just the nature of the beast.
Yeah, and during COVID, my son, who's now 22, but that was 4 or 5 years ago, he said to me, when I was only home for 3 days, and I said, I'm going back to work because we're considered essential. And my son, who was now, I think, in year 11 or year 12, he said, what do you mean go back to work? You don't work. And I said, what do you mean? And he said, well, you just sit on the phone all day talking to your mates. And I said, right. And he said, I can do that. And I said, but do you hear what we're talking about? Different bits of information and companies and brokers. I've just known them for a long time. It might be relax. But so that was funny in the sense that, he doesn't know what I'm doing. And I think of that a lot because the way I did it, I didn't know when I was his age because I didn't have enough money to put in the market. And the first bit of money I got, I put into the Telstra float. That's how old I am, giving it away in the 90s. And it made $15,000 for me. And I went, geez, that's interesting, the miracle of equities. So I saw the upside. And we were planning an overseas trip, my now wife, then girlfriend. And we bought the plane tickets with this money and we had a bit to spare. And I thought, this is great. And then I kind of thought, well, if I can do 15% a year from that point onwards until I'm 80, I can make $120 million on that capital base.
Nice.
and I thought, well, that's interesting. And then you start to grow up and have kids and whatnot, and you realize you've got expenses along the way that kind of get in the way of that number. But, it's the old Buffett stuff, the compounding. You just got to stay in the game and just keep chipping away. And some days will be horrible, absolutely horrible. As one person said to me, some days, in this game, when you get the bus to work, you feel like $1 million. Other days, you feel like you want to quit and drive the bus instead. It's a more stable job.
Absolutely.
But that's the idea. So if you ask us, I mean, I've got all my money in there in our funds. When I'm 80, that will turn into a big number if I just keep at it. We'll have young investors. We hired someone younger last year. We'll keep chopping it up because you need younger voices and minds in the room. But that's just evolution. But stay with the game, keep at it, keep chipping away. You won't get it all right. In fact, you miss a lot of stuff. But if you just get enough right and avoid the losers as best as you can, then eventually money grows.